Okay, guys, thanks for attending. Let's go ahead and get started on this webinar. I want to be respectful of your time. This is going to be some good information, I believe. Well, I'm a little biased since I've created this information for you, but it's going to be a lot, and so I want to make sure I give you a lot, and it's very productive because, quite honestly, you're paying for it. So let's go ahead and dive into this. This is Robert Wolf with Terra Firma Business and Financial Consultants, and today really what we're going to do is we're going to go through our retirement workshop that we call Economic Termites, and so let's kind of dive into some of these slides. In your workbook, hopefully you printed out your workbook before you attended. If not, please print this out as soon as you can. Get to it, and because we're going to go through the workbook as well. Give you a few minutes to fill it in as we go. The first page is a cover page. Second page is and third page is my bio, just a little information about me. The fourth page is our disclaimer here. This has been prepared for you as informational and educational purposes only. It's not intended to provide and should not be relied on for investment, tax, legal, or accounting advice. You should consult your own financial, tax, legal, and accounting advisors before engaging in any transaction. Terra Firma Business and Financial Consultants, LLC, and its affiliates do not provide investment, tax, legal, or accounting advice. Investment advice is offered through TF Wealth Management, LLC. TF Wealth Management, LLC is a registered investment advisor. All right, so there we go. We've got that housekeeping out of the way for all those that are in compliance. So what to expect in this webinar? We're going to do a quick little introduction, rules to follow. We're going to go over the 3 phases. We're going to talk about economic termites and the major financial institutions, and the last part will be food for thought. At the end of this, you're going to have the opportunity to go ahead and schedule a complimentary one-on-one session. That will be extremely helpful because in this workbook that you're going to be filling out, your notes in this workbook is designed that if you want to take advantage of that complimentary session, we're going to require you to send us your notes in the workbook so we have some information. So that way, that 30 minutes, 45 minutes of time that we spend together is completely productive. I don't want to waste your time. I don't want you wasting my time. You are going to be spending money on this this webinar, and I just want to make sure you get everything you need out of it. So that's why we're going to require that workbook to be sent to us. So if you don't have that filled out and you want to do the complimentary session, we actually will not set and schedule an appointment. We will reschedule that appointment until that workbook is sent to us and filled out. So again, we just want to be respectful of everybody's time involved, okay? All right, so let's go ahead and dive into here. So the introduction. So let's talk about who am I? Well, I am Robert Wolf, like I had said earlier. I created Terra Firma Business and Financial Consultants. My focus here is education, and I got really frustrated being in the business. I've been in the business since 2001, and just got frustrated with the lack of holistic education about the various assets that are out there. Not just necessarily the assets that are out there, but just the understanding of the various assets. I have found too many people were insurance agents, too many people were money managers, asset gatherers, insurance gatherers, real estate people just focused on real estate. There just really wasn't a cross-pollination of understanding of how the different assets work, and so I developed my consulting firm. I developed certain strategies. I work with a lot of business owners, a lot of physicians, trying to help them reduce some of their issues and increase their overall revenue and help them out. And so we do this from one purpose only, and our goal is to help reach your needs and wants by increasing your cash flow. Your cash flow is what drives everything, whether you're a business or an individual. It does not matter. Cash flow drives everything. You can have some wonderful goals, you can have some wonderful dreams, but if you don't have the right cash flow to accomplish those goals and dreams, what is the point. So our focus is increasing your cash flow, okay? Our approach is through education. As you will see in this workshop, this gives you a good indication, reason why we require the workbook to be sent to us, because we want to be able to have an opportunity to educate you on what you have, where to go, and we don't like wasting time. Your time or our time. We want to make sure that our time is all productive and that we're getting the information and the taking the steps that we need to. The other thing I found out as I went through these last 17 years is that all our biases change as we change. And what really changes or affirms our biases is the education. So I have found a lot of people going through our process, our educational process, have what they understood to be true actually was not true, because the information they were getting were from people who did not have the right information, or understanding, I should say, of the information. And so we believe that as an individual that you have an intelligence. God gave all of us a brain, and we can use our brain to its best ability if we have the right information in front of us. Obviously, you're going to ask for guidance and opinions, and that's where we come in based on our understanding of how things work. If you ask us a question and we don't have an answer, we're going to tell you that's a great question. We don't have the answer. Let's go find it, and we will go find it for you, and know that we will have done the research and brought that answer to you with all the research behind it as well, as best to our ability. Okay? So what's the most important non-spiritual thing that matters in this session right now? You. You are the most important thing. So all this information is for you. Now remember, this is educational, informational. I don't know you. So if I say something and you go, oh, Robert, that sounds really good. That is perfect for me. I'm not giving you advice at all. I don't know your situation. So just know that this information is all about you, and this class is all about you. Now, how did all this come about? So this is interesting. When my wife and I were newly married, I'm an avid reader, and I picked up a book by Robert Kiyosaki, Rich Dad, Poor Dad, as you can see right here. I read it, and I really liked his the way he approached the two dads and the education process of money, and understanding how money worked, and how different backgrounds of understanding of how money worked really dictates how our children understand money as well. Okay, and so when we read an author and we really like their book, what do? We go buy a second book. And so that's what I did. I bought his Cash Flow Quadrant, and this book was basically a life changer. I don't want to be one of those guys who go, oh, this changed my life, but really this book is what caused me to get into this business, because I really enjoyed people. I really enjoyed talking to people. I wanted to work with people, but I didn't want to just be in any average type of quote-unquote sales job where I was always around people. But I always had a fascination of money. When I had my own paper route when I was in junior high, I used to always open up the financial money section, and that was back in the day where on Sundays, remember, they would print all the stock quotes of the various stock companies. Now you can get all that online, but I would look through that and read through that, find companies that I knew. I had no idea what I was looking at, but I looked at it anyways, and it just was interesting to me. Well, this book laid the foundation of why I am doing what I'm doing. Okay, so let's talk about the cash flow quadrant and why this was so important. Okay, so if you go to page 6 in your workbook, the big question is what is the cash flow quadrant? Well, the top left is an employee. Okay, what this means is that you have a job, you trade time for dollars. That's why you see a little alarm clock and money there. You're trading your time for dollars. You negotiate with the employer what your income should be based on your experience, expertise, your age, your educational background, a whole bunch of different factors, and what they're willing to pay for all that. And that's how you generate income. Okay, now we're going to talk about some things throughout this entire workshop, and part of it's going to be talking about from a tax perspective. We're going to be talking about from an expense perspective. Typically what I have found is that this is an area where people negotiate their income, and their expenses meet or follow or trail their income. Okay, typically the horse is the income, and the cart, the trailer, is the expenses. And wherever the horse goes, the expenses go. If we get more horses, and the cart gets bigger. Is typically what I have found. Okay, now that doesn't happen all the time, of course. There's certain people and cultures that have a different thought process, and that's perfectly fine. But that's just obviously a generalization based on experience. Now, the other quadrant in the bottom left is the self-employed quadrant, where instead of having a job, you own a job. You are the boss, and you've negotiated your income really based on same thing as the employee, trading your time for dollars. So if you're a real estate agent, you trade your time for dollars. Now, you may be spending a lot of time marketing, and you sell a lot of homes, and therefore your income may be great. Or you don't do a lot of marketing. I don't know. Or maybe you're a CPA or an attorney. It really doesn't matter what you do in the self-employed quadrant. You basically own a job. The way you know that is you go on vacation for a week. What happens to your revenue or your income tends to go down because of the time away from the office. Okay. Now, this left side of the quadrant, if you notice on the top, it says 5% of wealth. Well, really what happens here is because from a tax perspective, the left side of the quadrant is the highly taxed, and when we go down through this process of this workshop, we're going to talk about tax brackets from an individual tax perspective, and you'll see what I mean by that. And that's really one of the reasons why the wealth is only generated about 5% of the population is from this side of the quadrant. Now, is that a hard rule of thumb, in that I have all these statistics and stacks and file cabinets and website links saved to back that up? No, I don't. That's just a generalization based on what I have read and saw from other people, and so I just left it there just as a guide. Obviously, there is an exceptions. I completely understand that. So please do not take offense to this. I'm not trying to be offensive. If you are being offended, if you are offended by this, it's just a generalization. Okay? Now, on the right side of the quadrant is a business owner, where you own a system, right? You make a widget, or you offer a widget, or you're in a service business where you offer a particular service or process as a business owner. Now, the reason why this quadrant is so important is because here we tend to have the aspect of a business owner really kind of controls their income in the sense based on how the widget is working. But also from a tax perspective, the business owner has a lot of tax benefits, a lot of deductions. And the reason why a lot of times we say in our business that business owners hire taxpayers, which we would call employees. So that's why on the left side of that quadrant, employees are right next to the business owner, because business owners, business is as successful as the employees that they employ. But from a tax perspective, the business owners tend to have a lower tax bracket just due to that, the benefits of being with the tax code. Okay, now down the bottom is an investor, where you own investments. Now, the definition of an investment, and I'm going to use Robert Kiyosaki and his advisors, their definition of an investment is something that generates income for you. So let me take a step back here and say that your home, if you own a home, it's not an investment unless it generates income. Now, through our planning process, we can show you how that can happen and how that can occur. But right now, we're going to go with the definition of an investor is somebody who invests their money, and that money and that investment generates additional income besides their own ability to earn as an individual or a business owner. Okay. So now on the page 6, under that in your workbook, circle the one that you want to be. And draw an arrow from the quadrant you currently are in to the quadrant that you just circled. Okay? All right. So now what I have found over the years is that there's basically 3 planning processes. Now again, this is a generalization, but I typically find that there's family planning is what I call it, basically financial planning. Okay, so you turn to page 7. Financial planning is the gentleman or the lady who comes to your house, or you go to their office. They ask you all what your goals and dreams are. They look at all your investment statements, your bank statements, they maybe a budget, and then all of a sudden they'll put together a financial plan, a 30 to 80 page document that is based on those goals and what your situation is and what the likelihood of your ability to quote unquote retire. Okay, that tends to be family planning. May include some life insurance, may include some annuities, or may obviously include some real estate as well. But typically a financial plan that I have seen historically will just give you that guideline of where you're at, where you want to go, and what you need to do to get there. Okay, I'm going to make a generalized comment again. Typically, I see financial planners in this realm typically offer stocks, bonds, mutual funds, ETFs, equities is what we call it in the industry, as the formula to get to that retirement. And then typically that's because most people have a 401k plan. Okay, now if you look at the business planning quadrant or the business planning circle here, that's where you have guys who maybe work with the business owner. They instill or install a 401k plan for the employees. They may do some key man life insurance or some kind of executive benefits for the business owner and their key people. But typically I see a lot of times in this segment that the business planner, if you will, is not the same as the financial planner and the family planning. There tends to be a segregation here. Okay, now both of those planning processes, family planning and business planning, typically will have an end result, which is what we call legacy or succession plan. And the reason being is that we don't live forever. We don't work forever. There's a point where we have an exit strategy. So the way we look at it from our perspective, from an educational perspective, look at it from three stages, and we'll talk about this in a minute, from the beginning, the middle, and the end. Okay, and so we're going to come back to this process and think about this, and we're going to look at it from the beginning, middle, and end. Now, list out who your current advisors are. If you turn to page 8, we give you a list. You can write out who your financial planner, tax preparer, insurance agent, attorney, if you have another advisor. Now, if you have a business, down on the bottom, you can do the same thing and grade them. Grade them 1 to 10, 1 being poor, and 10 being outstanding. If you have anybody that is a 0 or a -1, and then right now send them an email, get on the phone, fire them. Okay, that to me, even if you're joking, I don't even think that's a situation where I find it funny, because you work hard for your dollars, you work hard for your living, you work hard for your assets. Anytime you spend time away from your family or the things you enjoy doing, and you have somebody that's a 0 or a negative, they really do not belong in your life any longer. Okay, so go ahead and grade them. Take a couple of minutes there. I'm going to drink some water here and give you a moment to grade those individuals. Okay, I wish I had some background music to give you as well. But I don't. So I'm going to give you a few more seconds, and then we'll get started. Okay, so let's go ahead and get started. All right, so now that was our introduction, and the next step is what we're going to talk about is what I call the rules to follow. Okay, so what are the rules to follow? Well, I don't know if you've read a book called The Richest Man in Babylon, and the gentleman, George Clason, who wrote this in 1926, wrote this book. It's 100 and some pages, so not a very long book or extensive book, but he lays out some rules that you and I should follow when it comes to what the richest man in Babylon had done. Now, every single one of these rules, I will say at one point in your life, you have heard these rules. They're common sense rules. But as you go through the planning process, think about your existing plans that you have already have in place, and how many of these rules have you hit within those plans. Okay, so there's 7 rules he lays out. The first rule, pay yourself first. So on page 9, I give you in your workbook a section where you can write out how much you pay yourself first. So what are examples of paying yourself first? If you have a 401k plan at your company, or a 403b or 457, some kind of retirement plan that you contribute to on a monthly basis, whether it comes out of your paycheck or automatically comes out of your checking or savings account. Okay, so this is pay yourself first. A good example of this also would be if you have real estate, right? You can include your home as this, because as you pay your home, typically most people pay down the principal with their monthly payments, so that can be considered a portion of pay yourself first, because that equity is yours, right? So go ahead and fill that out. Then rule number 2 is control your expenses. On page 17 in the workbook, I have a basic budget. Now, I say a basic budget. It's very high level. We don't care what you're spending on Netflix or Hulu, or if you have a food company service that comes and provides you food and all that stuff. We're not concerned by those details. We're concerned more by a higher level. Now, what we don't care about is what you spend your money on. It's your money. But as we go through the planning process, one of the things we do is we do look at some of the expenses as we go through the planning process once you've engaged our services, and then we'll look at that kind of stuff. Okay? But right now, just go ahead and write out what you think on page 9, what your expenses are. You don't have to go through the budget right now, but just it would be kind of fun. Write out what you think your expenses are. And then as you go through that budget, see how accurate you were. Okay? Now, the third rule is earn a fair rate of return. Now, I always find this funny because the word fair is very, very broad. Some people think a fair rate of return is 12%, and some people think fair is 4%. I don't know. That's why we use earn a fair rate of return. And so we talk about that in our planning process. We're not going to do that here, but go ahead and write out what you think is a fair rate of return. And then what you can do is actually look at your other investments after this webinar, and after you go look at what your rate of returns are there and see if it matches what you think is fair. Okay? Now, rule number 4 is don't lose money. I love this rule because everybody automatically thinks of the stock market, their 401k plan, right? Oh my goodness, 2008, or oh my goodness, there's a lot of volatility, and last week it went down 4 or 5%, or went up 9, 10%, or up 4%, down 10%. I don't know. But when we're talking about rule number 4, we are not talking about your investments. When we're talking about don't lose money, what we're talking about is all the other things you spend your money on. So, for example, do you really need cable, Hulu, Netflix, Amazon? As an example. Okay, I'm not advertising or marketing any one of those. I'm just saying that these are typical household names of plans that people have. Do you need all of those? Do you need the NFL Network, the NBA Pass, and all these other? I don't know what all of them are called. I personally do not have cable. We have Netflix and we have Amazon only because it comes with our Amazon Prime membership. So what are you spending your money on? Do you need all of those? If not, get rid of one. That's losing money that's going out the door. Okay, that's an example. The terms on your vehicles or on your mortgage, or credit card payments and the interest on the credit card, or do you leave the air conditioning running? There's a whole bunch of different examples. Now, I'm not talking about being a miser and and cutting coupons, and every time you leave a room, you don't need to yell at people for turning the lights off or not turning them off or whatever. I'm just saying that there's other areas other than the investments of where we lose money. So I think this is a good opportunity, especially as you go through your budget on rule number 2, and see what areas are you spending your money on that you may not need to, or you forgot that money's coming out of your checking account and you didn't know that. Okay? So rule number 5 is own real estate. Now, you can go to page 18. We have a real estate fact finder. This is important for us because some people have primary residence, but they also have, let's say, their first home or a condo that they decided to keep and they rent it out. Okay, or they have other types of real estate property as well. So this is important because go through the real estate fact finder. If you have more than 2 properties, go ahead and just make a photocopy of that at home, or just take a notepad and just write down those other pieces of real estate. Because it's interesting when we go through this process, at least with clients, they didn't realize that the rent they're charging their tenants is way below market value. Some of them didn't realize the expenses that they had within the properties were below or were above the rent they were collecting, or they didn't know the HOA fees in that particular rental property went up, and it's eating away at their rent. Okay, because it's not a business to them, it's a hobby, and so it's all typically what we see a lot of times. It ends up being in their normal checking account, and so they don't know that money is eating away at their other money as well. Part of rule number 4: don't lose money. Okay, so now on page 9, I say, do you there's a yes or no. Do you have a house? Circle yes. If you don't have a house, circle no. Do you have other real estate besides your house? Circle yes or circle no. Okay, rule number 6: protect your family. You can go to page 19, and we have a list of what we consider as protect your family list. What is protect your family? Now, that really depends on each and every single one of you. Some people, it may I have an alarm on my house. Some people my child has a cell phone. Some people may think it's life insurance, or having a higher liability on their auto insurance, or their identity theft program. I don't know what it means to you, but protect your family is extremely important to understand. How are we doing this? What are we doing to protect our family? Okay, you as the breadwinner, if there's a single income family, what are you doing to protect the breadwinner? Does he or she have disability insurance just in case they become disabled? If you're the only breadwinner, maybe that's important to have just in case, knock on wood, right? So these are all things that are important in the planning process as well. Now, rule number 7 is increase your ability to earn. What in the world does this mean? Is this important to you, to increase your ability to earn? Circle yes or no on page 9. What we're talking about here is the other rules. Is if you're increasing your ability to earn beyond just yourself as an individual, then you're having the opportunity to be an investor. So, for example, if you're paying yourself first in the first rule, and you're controlling your expenses, and you're looking to earn a fair rate of return, and you've put a plan in place to where you're not just throwing money away, is that extra stuff? How are you adding other assets to where they can compound, increase your ability to earn? So those are things that you want to take into consideration as well as you go through this process as well. Now, rule number 8 we added. It's not in the book. It's reduce your tax liability. Okay, is this important to you? Circle yes or circle no. Okay, so now that was the rules to follow. So hopefully that was helpful. If you want to go read the book, go buy the book and read it. Now we're going to dive into the 3 phases to asset building. What are the 3 phases to asset building? Well, the first phase is contribution, the second phase is accumulation, and the third phase is distribution. So this is back, if you remember when we were talking about family planning, business planning, legacy, and succession planning, those 2 circles. Now, the 3 phases, contribution is the beginning. Right? So if you're contributing to your 401k plan, that money is the beginning stage. And that money is going to hit the second stage, which is accumulation. It's going to start to hopefully grow, right? Now, at that some point, there's a distribution or an end stage. If you never pull out the money, at some point you're going to die and the money is going to be pulled out anyways, right? So there is an ending to assets as well. So in all asset building, there's a beginning, middle, and end. Okay, contribution, accumulation, distribution. Now, how many of you are looking at these assets as you're doing asset building? You're also looking at the tax benefits or consequences to each of these assets as well. That's important to understand as well. So In page 10 in your workbook, what are you currently contributing to? Okay, so I put some here. You can write in, so like your 401k plan, if you're for your 401k, if you have real estate, if you have cash value life insurance, you can put that in there, like whole life or universal life. Whatever else, brokerage account, CD, okay? Whatever you're contributing money to as an asset building, what you think is an asset, go ahead and list that there, okay? Next to it, you can put the dollar amount if you want to, just for your own notes. This is your notes again, and maybe it'd be helpful for us when we have our, if you decide to, at the end, to ask for that complimentary session, maybe that would be helpful to have that information there as well, so we can dialogue and talk about that. Now, are the above accumulating? Yes or no? Do you have a plan of how to distribute? Yes or no? Meaning, okay, you're putting money into it, it's accumulating, this is fantastic. Have we ever thought about how it's going to come out, when you're going to use it, how you're going to use it? Are there rules to when you can use it? Okay, those are important to understand. Do you know the rules of each asset in each of these phases? And do you want to know? Okay, those are important things to have as well. Okay, so let's talk about this. Most people think that when we're talking about these stages, they're thinking about retirement. Okay, we're not just talking about retirement, folks. We're talking about asset building. Asset building. Now, there are certain assets that are deemed and specific for retirement with certain rules that are laid out by the regulatory bodies, whether it's the IRS or the Department of Labor, such as the ERISA rules, like the 401k plans at your employer or a pension plan. Okay, now we're talking about asset building. We're talking about anything that is an investment or an asset that accumulates. What's an asset? Something that should appreciate. Okay, should appreciate something. If it's an asset, we look at things that should appreciate, which should also create some sort of income benefit to you, compounding of interest. Okay, Robert Kiyosaki and his advisors talk about this term called velocity of money, where you have multiple assets accumulating or compounding, to where these assets actually are compounding, accumulating faster or above your personal ability to earn. That's what we call the velocity of money. Okay, so let's take a look at this. Typically the contribution stages starts at age 25. Why? Well, that's really when you're done with college, you get your first real job, you're no longer working 4 or 5 part-time jobs to cover your expenses. Now, they usually say contribution lasts until retirement. Well, why till retirement? Why not till past retirement? Okay, if you're building assets, your assets should always be contributing to yourself. Now, contribution doesn't necessarily mean you are contributing. What if you have an asset that is contributing? Okay, because it's creating income, right? So now things are accumulating. We put age 25 because that's when you start contributing, you start accumulating. Now, these are just roundabout numbers, of course. Now, we assume accumulating as age 100, or what I put, lifetime. All right, you should always be accumulating. Okay, you should always be accumulating, and you should always have the focus of your contribution or accumulation on the exit or the distribution. Now, typically we say 65, 66 is retirement. We don't like that idea because we like to look at things from a lifetime perspective. So I put age 100, but really we look at a lifetime perspective, and that's where that plus is that we can also design some of these assets. How do they pass on back to that legacy or succession bubble? Okay, how do these assets pass on to the next generation? Or if we don't have any heirs, we want it to go to a charity or our alumni, right? Our alumni association with the university we went to, or whatever you want to do. Okay, but that's what that plus signifies or indicates. Now, there are 3 great truths. Okay, now I say 3 great truths because there actually used to be 2. I'll give you the first hint: death. Okay, that's right. You already got the second one, taxes, right? Death and taxes, the 2 great truths, right? Well, there's a third, and any idea what this third truth is? Debt. Debt is the great third truth. Okay, I don't know, have you ever been on usdebtclock.org? All right, so if you haven't, let's take a look and see what this website looks like. I'm gonna back this out. Okay, so your screen's gonna change a little bit here. If I can get my cursor to work here. Okay, there we go. There we go. All right, sorry about that. Okay, so we're going to go to 100. Now, the way this site works is that over to the left here is the U.S. national debt. Okay, this is acting as real time. Here, the green section, this middle to right section, is revenue. It's all green. So what's revenue to the government? Taxes. That's the only way they really generate revenue, right? The budget items are right here. We can talk about interest on the debt here. We can talk about gross domestic product. And we can talk about all this other data and all this other information and money creation and all this other kind of stuff. We're not going to talk about that. We're going to just talk about this top section. Okay, so I'm going to zoom back to the 150. All right, and so let's take a look at the debt. Okay, so let's look at this. This is 1,000 million, billion, trillion. So $21.7 trillion is the national debt. So what's that mean per citizen? So the debt per citizen is $66,000. The debt per taxpayer, which is not the same as citizen, the debt per taxpayer is $178,000. Okay, that's significant. So the federal spending is up $4 trillion or up 132%. That's not a good thing you want to see, right? You don't want that to be up, do you? The U.S. federal budget is budget deficit is up $831 billion. Okay, now if we looked at the largest budget items, Medicare, Medicaid is up at $1 trillion, almost 1.1 trillion. Social Security is 990 billion. So you add these two things up and you got 2 trillion. All right. Defense, war on defense is 670 billion. So there's a lot of people who think the war budget is defense budget is way too much. Well, in comparison to some of the other things, it's pretty low, right? Federal pensions, retirement accounts for federal employees is $262 billion. Interest on the debt is higher than the federal pensions, is $330 billion. Okay, and then income security are like welfare and disability and some other social programs in there. Okay, now if we look at our income, how are we paying for all this? Let's look at the taxes. So tax revenue is up 65%. Is that something you want to be excited about? It's yes and no, right? Because we just saw how much debt we're in, but who pays for the debt? You and I. So if debt's going up, then taxes have to go up, right? But we had this great opportunity where we had Tax Reform Act, taxes went down, blah, 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 right? Well, how do we pay for taxes? Well, we really got to mortgage it as a country because that spending is still happening. So how do we pay for lower taxes? Through debt. Okay, and so it's kind of it's got to be paid somehow. The spending has to be paid somehow. So typically in the country's history, what really works out well is that if we have low taxes, then we also have a lot of spending cuts as well. Okay, and this is not a political conversation. This is just a math conversation, right? So when you look at 3.3 trillion, if I can bump this up to 0.3, so $3.3 trillion in tax revenue, that equates to $10,000 per citizen. Well, what was it per taxpayer? It's $27,000. So when we look at over here, the debt per taxpayer is $178,000, and the revenue per taxpayer is $27,000. We have what, almost $150,000 difference. If you manage your checkbook this way, and you had this much more debt than you had income coming in, what would happen to your personal checkbook, right? Pretty significant. Now, income revenue, income tax revenue is 1.6 or 1.7 trillion. Payroll taxes is 1.1, so you add these two up and you got $2.8 trillion. Corporate tax revenue is $207 billion. Tariffs, right? Everyone's complaining about tariffs. You can't put tariffs on China at 200. Look, we only bring in about $55 billion in taxes from other countries. How much money do we have going out to other countries versus how much we have coming in? Okay, so yes, there's a whole lot of yings and yangs with regards to this, but kind of gives you an idea. So if we're not bringing in money through tariffs, who's paying for this? You and I, okay, as taxpayers. Okay, so I just wanted to kind of go through that and as a highlight. I'm not going to go through everything else. Let's go back to our presentation here and walk through some of the other things, okay? Okay, so what to expect. Now let's talk about what we call economic termites. All right, this is a term I developed. So what is economic termites? Well, economic termites, the best way to describe it is, let's talk about termites. What are termites? That's right. They're little insects, little bugs that eat away at wood, right? And they'll eat away at your house or the porch. So when you have a termite problem, when do you know you have a termite problem? That's right. When the damage has been done, right? So if the damage has already been done, what do you have to do? You got to stop it, but then you got to also fix it, right? So I looked at that and I said, hey, you know what? Economically, we also have termites. And we have economic termites that eat away at our wealth. And what are those? Okay, so we're going to talk about the top 4. There are others, and we're going to go through the others and just kind of let you know what they are. But the rest of this is really going to try to focus on these top 4. Okay, so the first one is taxes. That's the biggest economic termite that affects our wealth. Inflation is number 2. This is the silent economic termite that most people are unaware of, all right? Our purchasing power. Time is also kind of the invisible one, where we get busy and we get caught up in all of our life, right? And it's easy to do, and all of a sudden, holy cow, where'd the last 5 years go? Or where'd the last 10 years go? And then laws and regulations are the 4th economic termite, major economic termite. Well, how's that possible, Bob? Well, when there's law changes, right? Regulatory changes. When there's red tape or blue tape or green tape or whatever kind of tape there is, all those decisions affect our wealth, okay? Sometimes positively, sometimes negatively. We just need to know what those are, okay? Now, the other type of economic termites are interest rates. Now, this is a problem depending on what side of interest rate you're on. Okay, so if you're a retiree and you have a fixed income and your income's based on interest rates, when they go down, how's that affect your income? Not so good, right? But if you're accumulating assets, or you have debt, or you have investments that require debt and interest rates go down or go up, how's that benefit you? Okay, procrastination, just not doing stuff, right? Putting your head in the sand, that's not good. That eats away over your wealth, because that goes back to the time termite, right? Running out of money is also an issue. Stress and sleepless nights of watching your portfolio dwindle. Now, we say portfolio, and most people go, oh, this is my investment portfolio. We're talking about assets in general, all of them. All of them. What happens if they're dwindling that? Well, if you're using your assets as income because you're no longer working, you're retired, and your overall portfolio dwindles down because of your spending. But also, what if there's some economic situations like inflation effect, or the taxes go up, or there's a new law that affects, that all causes your portfolio to dwindle. The volatility of the stock market, if you're heavily into the stock market, right, the volatility could affect you. How about just a health issue, right? Just a health issue. How's that affect you? And it may not even be your health issue, or even your spouse's health issue, or partner's health issue. What if it's a friend or a family member? Right? And you need to help, or a child, right? So health issues could be also something that eats away at your wealth. Now, of course, there could be other things that we could add to this, all right? But these are the major ones that we look at, okay? So let's take a look at taxes, all right? So if you go to page 12, page 11 showed the economic termites, and you can circle yes or no if these are concern of yours. If they are a concern, circle yes. If they're not, then circle no. If you don't care, then guess what? Don't circle anything. So now let's talk about the taxes and tax brackets. This is based on 2018 federal tax brackets, okay? So on your workbook on page 12, you can write in what your adjusted gross income is. If you don't know what your adjusted gross income is, or what that means, go to your last tax return, which is 2017 at the time of this webinar, right? So look at your 2017. On the first page of your 1040, your 1040 is your personal tax return. Go all the way to the bottom, and it could be right around like line 37. The last line says adjusted gross income. That's your AGI. Write that there. what federal tax bracket are you in? Well, let's talk about it right now. So if you're single, you're going to look at the right side. If you're married, filing joint, you're going to look at the left side. So look at your AGI. Now find that in here. So how's that work? So let's say your AGI is 200,000. Okay. So I make 200,000. So and I'm married, filing joint. So we earn between 200. So you're going to be between the 165 and the 315. So you're going to be in the 24% tax bracket. Okay. If your income's higher and you're, let's say, 350, well, you're going to be in the 32% tax bracket. Or if you're 650, okay, you're going to be at 37%. Now you do the same thing if you're single, filing as an individual. Okay, and that's how. Now, how do these? Are you happy with that? Is that exciting to you to be in that particular tax bracket? Well, what's that mean to you? Well, if you make between the 24% tax bracket, let's say you make $315,000 exactly. Well, the first $165,000 and you're going to owe $28,000 in taxes. Well, how's that work? Well, this is what we call a progressive tax system. So what that means is that if you make between 0 and 19,000, you're taxed at 10%. So basically 0, right? So over 19,000, you'll be taxed at 10%. So you hit here, the second, let's say you make 50,000. So the first 19 is at 10%, so that's the 1905. And so anything between 19,000 and 77,000, okay, is going to be taxed at 12%. So let's say you make 77,400. So the difference between the 19 and the 77,400 is going to be taxed at 12%, or $7,002. That whole tax bracket, you add those two up, and that's what you owe in that whole tax bracket. So let's say you make over 77,000. Well, guess what? That you owe that whole tax bracket, which is 8907. And whatever difference between 77 and 165 is taxed at 22%. Okay, so that's how the progressive tax system is. So kind of the government's sweet spot are these two areas, really. Okay, now they're going to take income tax anywhere, right? They'll be happy with anything. But this is kind of where some of the sweet spots are. So this is typically the middle America, right, or middle class, if you will. All right, and then here's the upper middle class, if you will. So the 400 to 600, okay, typically is what we see. Now, obviously, that can change, right? So I'm just making generalized statements here. So now, inflation, how's inflation work? Well, let's look at the history of inflation. So if we looked at 1917 here, inflation was at 17.4%. That was 100 years ago, right? That was a while ago. Okay, so if we looked at these last years, last 20 years, okay, last 40 years, 60 years. So let's look at the averages. The last 10 years, the average was 1.76. Last 20 years was 2.155. The last 30 years is 2.6533. Now, I highlight this because this is typically what we will do the planning process with. Okay, if we want to be more conservative, then we can go with the 40-year at 3.7 or the 50-year. But typically the last 30 years, and the reason why I do the last 30 years is because that's when we've had a lot of economic change. Okay, so if we were to look at it again, so we have 120, 130. So 1987 was 30 years ago. Okay, so what was really happening in the late 80s, right? So all of a sudden we started hitting some economic situations. Technology starts improving, computers start improving, right, and becomes more focused. And so into the 2000s, when we had our economic situation in the 2000s, right? And then technology in the 2008, the financial crisis, so on and so forth. So that's why I look at the last 30 years, is because there's a lot of change that's occurred in the last 30 years, right? So we can change that, but that's really, what's that mean? Well, your purchasing power or your earning power has to keep up with this. So if your purchasing power reduces by 2.6% every year, well, how does that affect you in your income? Well, you need to make sure your income keeps up with that, okay, or eats away at your wealth. Okay, so now let's take a look at time. And when you meet with us and we go through and you gauge us, we'll go into more depth on how the inflation works and how it affects you. And towards the end of this webinar, we'll also show you as well. Okay. So now if you look at the time termite, what's that mean? Well, if we look at the last 30 years again, so 1988 to 2017, here's what the S&P 500 is. Okay, so let me disclaimer this. We are not giving investment advice right here. We're not saying that the S&P 500 is something you should invest in or you shouldn't. Okay, we're only using this because it's a guide of the general financial well-being of the 500 largest companies in the U.S. Okay, we're not saying that this should be your guideline. Okay, we're just using this as an educational video to talk about time from this perspective. Okay, now when you look at the S&P 500, you know, over the last 30 years, if you will, there's only been really 5 moments where we've had a negative situation, right? So let's take a look at that. I'm trying to get my cursor here. There we go. So in 90, the 2000s, and 2008, right? Now I also highlighted all the times where it was above 20%, so much more than the negative, right? But when we look at the average rate of return since 1988, the average rate of return is 12%. Who here actually thinks that the next 30 years is going to be an average 12%? I don't know. Is it? How about since 98, the last 20 years, an 8.8%. Look at this, the last 10 years has been an average of 10%. Who thinks that the last 10 years we're going to get, the next 10 years going to get a 10% rate of return? I don't know. So it kind of gives you an idea what the averages look like when you look at the actual returns versus the rates of returns, right? Okay, so let's look at it from a picture perspective. So here's a picture perspective, and here's the early 2000s where it went down, and then after the early 2000s it went up. Here's the 2007 to 2009 where it went down, and then it's gone up, and we've had some hiccups, right? But it's gone up pretty well from there. Okay, so this is as of June 9th of 2018. Okay, so let's take a look at the break-even. This is the break-even. So what would happen if you were planning to retire right now and we took an average of the 2 downturns, right? So we took it from the early 2000s and the 2007, 2009, and we added them together, divided by 2, and that was the average. What would happen? Well, we would have a 49% loss, or we would be below break-even from the early 2000s. Is this something you can handle? I don't know, right? So this is something we have to plan for or not plan for. I don't know your situation. Have I beat that drum dead? Okay, so but it's important to have this conversation, the discussion. If this is not comfortable for you and you are planning to retire and you are heavy in a particular asset gathering area, then we need to take a look at that, right? So when we look at the S&P 500 over the first 6 months of 2018, here's what it looked like. Here's the break even for the first 6 months of 2018. In the green is the up days and the red are the down days. We've had 71 up days and 53 down days, and look where we're at. We're kind of at the break even. So what does that tell you? It kind of tells you that the down days tend to be much more significant than the up days. If we looked at the last 6 months of the year up through October, okay, then what's it look like? 13 up? Pretty consistent, right? But we have felt that it's been pretty volatile. Where's the break even? Well, you see where the dotted line is and where it's at. The S&P 500's at based on this chart. So this is October 16th. Okay. So what's that mean to you? I don't know what it means to you. I don't know your situation, but it's just important to see from a time perspective. So then I have people ask me, well, Bob, what's the perfect investment? Okay, so if what I just showed you is of concern and you're not sure what to do, if you look on pages 21 to 25 of your workbook, Okay, that's what we call our risk tolerance questionnaire. Fill it out after this webinar. Fill it out, and it'll ask you questions to see if you're comfortable with what you just saw. If you are, then fantastic. You've answered the questions based on that. In your tolerance, say yes. If you're not comfortable with it, whatever the answers to your questionnaire will give us an idea, give you an idea, and your advisors what you should be looking at or doing. Okay, so that's important to have as a guide. So people go, well, then what's the perfect investment? Well, I don't know. Let's take a look at this. Okay, what is the perfect investment? Something that offers guarantees, that are safe, that has income, that's tax-free, that fluctuates low fluctuations, right? It doesn't go up and down like we just saw. Maybe that was low fluctuations for you. Maybe it's not. I don't know. Something that hedges inflation. What's hedges inflation? Means that it stays ahead of inflation, right? Stays ahead of the purchasing power. The cost of our purchasing power goes down. We want a rate of return that stays ahead of that. Okay, we want long-term growth rather than short-term growth. We want liquidity. We want something that's diversified. We want something that's flexible. Can you find an investment that offers all these things? I don't know. It seems pretty difficult to find something that can do all this. So what do we have to do? Well, we have to look at the perfect plan, right? And what's the perfect plan? Well, it incorporates these 10 things as well as other situations based on you personally, right? How are we going to deal with that? Is it going to be one particular product, service? I don't know. I don't know. Typically, from my experience, it'll be multiple. It'll be multiple. Okay? So let's take a look at how we do that. Okay? So let's look at the major financial distributors. Okay? All right. Now, if you in your workbook you saw on page 14, what are you trying to accomplish? So I laid out those things. You can check it. You can prioritize them. So whatever you checked. If you want to prioritize, so if you only checked 2 or 3 and you want to say which one of those 2 or 3 is more important, middle important, and the next important, or if you want to check all of them and then prioritize all of them, go ahead and do that. Okay, that's up to you. Now let's take a look at the 3 major main financial distributors: banks, investment companies, and insurance companies. Those are the 3 main financial distributors. Banks represent leverage, investment companies represent risk, and insurance companies represent safety. Okay, so let's talk about these 3 things. Well, why do I say banks represent leverage? Well, I'm not sure if you can see this or not, so I'm going to try to bring up my cursor. Hopefully it starts working well. Okay, so what it says, as of January 18th, 2018, so this year, what it said is that if there's a reserve requirement, so according to the Federal Reserve of the United States, this is from their website, their monetary policy on reserves. What that means is that what do banks have to hold as a reserve? If they have more than 122.3 million, they're required to hold at least 10% of liabilities. So what's that mean? So let's say you have $100,000, you deposit in the bank, they're only required as a bank to hold on to 10,000 of that just in case. Okay, the other 90,000, what do you think they're doing with it? Well, what do banks do? They lend money out, right? That's leverage. Now, you may be getting a bank loan, right? That's how you bought your house or your car, or you have credit cards or a personal loan or student loans. All those are representative of bank and leveraging, and that's to your advantage. But it's important to understand that banks represent leverage. So in 2008, when we were having our financial crisis, quote unquote financial crisis, the too big to fail and all that concern was this here. Okay, because we were heavily leveraged as a country. Okay, now investment companies represent risk. Well, what's that mean? Well, according to Vanguard, okay, I used Vanguard because everyone understands who Vanguard is. If you don't, then any mutual fund company or investment company that you have investments with are going to have the same disclaimer or disclosure. And what it says is that the performance data shown request represents past performance, which is not a guarantee of future results. Investment returns and principal value will fluctuate, so that investor shares when sold may be worth more or less than their original costs. Current performance may be lower or higher than the performance data shown. So whatever they're showing here, you actually could have a higher or lower rate of return. They don't know. This is a disclaimer on pretty much every mutual fund that you get, pretty much every situation. What are they saying? Well, you should know that you could lose your money. But at the same time, you should know you can make money. Right? But you need to know that you could lose money. Go back to that risk tolerance questionnaire and see how much of the risk you're willing to take. Okay? That's important to know going forward and moving ahead. Okay? Now, insurance companies represent safety. So what's this mean? Well, according to the National Association of Insurance Commissioners, the NAIC, okay, each state governs their own insurance, and they have their own insurance department. Okay, and so all the commissioners of these departments in all 50 states get together, and that's what the National Association of Insurance Commissioners is. Okay, and they all lay out guidelines. So we're going to use California as an example. Okay, and then we're just going to go to the top line, which is life insurance. So what they say is life insurance, if you have an insurance company that is doing business in the state of California and they have $2.25 million of capital, $2.25 million of capital, then they're required to have a surplus of 100%. So what they're saying is, based on capital, they're required to have dollar for dollar of surplus versus capital. Okay, so that's 100%. Why? Well, because insurance companies are a contract to fulfill a risk or liability that you may have. So for example, life insurance, if you have a life insurance policy, it's a contract that says that you're going to pay premiums, and if you die, they're going to pay a death benefit to your heirs. Where's that money going to come from? Well, we want to make sure that there's money there, right? So they want to make sure that the capital is 100% there. Now, insurance companies have the opportunity to have investment income. There's a whole bunch of other benefits that insurance companies have to help with the safety and these dollars. If you engage our services, we can talk about in more detail how insurance companies financially maintain or how their fiscal responsibility looks, okay? But we don't need to talk about that here and right now. Okay, so if you go to page 15 on your workbook, and which of the three main financial distributors are you using? Okay, you have banks equal leverage. There's some of their products, right? Insurance companies represent safety, some of their products. Investment companies represent risk, some of their products. Which ones do you have? Check one of the boxes off. And if you want to, do a dollar sign next to that so you kind of have an idea of how you're balanced between the different three main financial distributors. Okay, but we don't care. In our firm, we don't care what all these things are called. What we care is that we see them as tools. Okay, what's that mean? Well, as tools, they're supposed to accomplish something, right? We don't care what they are called, we care what they do. Just like I don't care what a wrench is called, I care what a wrench does. Or hammer, or if you're a physician, a scalpel, if you're a accountant, a computer or software or a calculator, right? You don't care what something's called, you care what it does. And so we care about these tools and combining these tools to kind of create that perfect plan, if you will. Okay? So now if you want to take a break, you can go ahead, but we're going to keep going. We're getting towards the end of here, and so hopefully this has been very helpful for you right now, and you've been filling out the workbook as we've been going along. So now let's go through some what I call food for thought. Okay? Now, again, the main economic termites that we tend to do planning for is taxes, inflation, time, laws, or regulations. Okay. Now, when it comes to taxes, we want to make sure you understand that you have choices. You have 4 choices. You can have your income be taxable, tax deductible, tax deferred, or tax free? Of the four, which would you prefer? Now in your workbook, on page 16, you can check the box next to it, put the dollar amount of the amount of income or what your current asset balance is in each of those. How do you know what those are? Okay. Most people want tax-free, but most people are in taxable buckets, or most of their income is taxable, whether it's their employment income or they have assets that are generating rates of return that become taxable income. Understanding the rules of your asset is important to also understand your tax choices within those rules of those assets. Okay, so let's kind of go through and talk about this a little bit. Okay, so let's talk about what tax deductible means. And I'm going to use a 401k plan as our example. Okay, I'm not saying that they're good, they're bad. All right, we have no real opinion on what they are other than that they're a tool to accomplish somebody's goals, to increase what we talk about is their cash flow, right? So let's talk about this, tax deductible. So let's say you earn $100,000 a year and you decide to contribute $10,000, so the first stage, right, contribute $10,000 into your 401k plan. Okay, so that means at the end of the year, your taxable income is $90 because we get to deduct the $10,000 from your taxable income. Okay, so what happens is from a tax savings perspective? Well, that $10,000, if you're 22% tax bracket, then you're saving $2,200 because it's not being taxed as income, right? So you have a $2,200 savings, and this is why most people do a 401k plan. Now, if you do it over 30 years, that means that that's a $66,000 in tax savings over that 30 years. Assuming the 22% tax bracket is the same tax bracket for the next 30 years. You and I both know that's not true or possible, and that's going to fluctuate, but it gives you a guide and gives you an idea, right? Okay, so let's look at tax deferred. Well, what's that mean? Well, that $10,000 in a contribution now gets to accumulate, stage 2. Now it's accumulating, let's say at a 5% appreciation over that same 30 years that we made that contribution. So that equates to a time value money of $664,000. Right? So now you say, well, I want income. I need $66,000 of income because of my expenses. So that ends up being, let's say, 10% of your balance. Now, because it's coming out as income with 401k plans, when you're distributing it, the third stage, it is ordinary income tax. So let's say that takes $66,000 at today's tax bracket, it would be a 12% tax bracket. So on the $66,000, you would owe 12% or $7,500, say $7,600 in taxes. Over a 10-year period equates to more than what your overall 30 years of tax savings was. Okay, so you saved for 30 years to get $66,000 in savings, and over a 10-year period, you end up returning that tax savings back as taxable income. Okay, now this is an example. This is why we talk about knowing the rules and assets. If you're fine with this and this is great for you, then fantastic. Then this is how it works. Great. If you don't like it and this was new information to you and this makes you mad, then okay, now you know. Okay, here are the rules that we're talking about. Okay, all right. So let's see here. All right, so let's go through. Now, in your workbook, I gave you an example, so you can actually go through this on your own in the workbook. Okay, so let's go back and let's look at this. So your income, you can put your income there under tax deductible. You can look at your federal tax bracket, like I showed you earlier. Okay, you can take what your contributions to your 401k plan are, or you can put those in there, put your federal tax bracket there, and then you can see what your savings is. If you've done that over the last few years, or you're going to plan to do it for the next few years, you can multiply and kind of give you an idea what your tax savings is. Okay. Now, if you have a time value of money calculator, you can get an app on your phone, or you can go to Excel. The spreadsheets, Microsoft Excel also has the time value of money, but you can put your contributions times the percentage or what you think is a rate of return that you can get, all right, times how many years you're going to do this, and that kind of gives you an idea of what your quote-unquote account balance will be like. And then if you want to take an income, what kind of income you would need based on inflation and expenses that you have now, and so you can do that. All this stuff we do for you. When you engage our services, we go through this process with you to show you what your expense and income is and all that fun stuff. Okay, all right. So let's go to look at a couple quick case studies as an example of distribution. Okay, the efficiencies of withdrawal and the order of money and how it can be withdrawn. Okay, so let's assume that you're age 70 and a half. Now the reason why we're doing 70 and a half is because this is when the IRS says that you have required minimum distributions, RMDs. If you have not heard that term before, what it says is that if you have a ERISA, 401k, IRA type account, you're retired and you've saved the money up and you haven't used the money yet, the IRS, the government, has a formula that requires you to start taking money out. Well, why? You're probably saying, well, why is that fair? They can't do that. Well, they can, and the reason being is that those accounts were tax efficient, right? You had a tax deduction. We just went through the formulas, right? You have a tax deduction in the beginning, so you're not paying any taxes. You get a tax savings. The money's accumulating tax deferred, meaning you're not paying any taxes on the gain. So at some point, we went through the debt clock, right? And we said that the revenue for the government is taxes. So far, they haven't gotten any revenue from your retirement savings. So the RMDs are a way that they're getting revenue. Now, if your income that you're taking out of those accounts are greater than the required minimum distributions, then you're fine. But in this scenario, what we're going to say is we're going to assume that you're 70 and a half right now, okay? And we're going to say that you have a taxable account value. You have a taxable account value of $200,000, meaning that this is like let's say a CD or a brokerage account that's not within a retirement account, IRA, or anything like that. Okay. Now let's say you do have a traditional IRA and it has $500,000 in there. So you've done really well for yourself. You have $700,000. Congratulations. Now we're going to assume a rate of return of 5%. And we're going to assume a tax bracket of 25%. Okay, so we're trying to keep things very simple math-wise, rather than look at today's brackets or like yesterday's brackets or which income, if you're an individual or married. We're just going to keep it very basic, and we're going to talk about 25% tax bracket. And then we're going to assume that you need an annual withdrawal of $25,000. Okay, you need an annual withdrawal of $25,000. Okay, so those are kind of the profile or the rules moving forward. So let's look at a couple situations. All right, so we have one situation, option A, where we can take all withdrawals from our traditional IRA. Well, what are the withdrawals? That's that $25,000, right? So every year we can take $25,000 out of our traditional IRA and then leave the taxable account, that $200,000, leave it alone. We don't want to touch it. Just leave it there. We got our retirement account. We're going to take our $25,000 out of our retirement account. Okay, that's option A. Option B is just the opposite. We're going to take the $25,000 out of our taxable account, and then when the required minimum distribution formula says that we have to take money out of the IRA, we're going to do that. So we're going to look at this IRA, the required minimum distribution dollar amount first, because we're required to take that out. So whatever that dollar amount is, subtract that from $25,000, and that tells us how much extra money we have to take out of our taxable account. So let me give you an example. Let's say this required minimum distribution says you have to take $10,000. Okay, so we take $10,000 out of the IRA. So subtract $10,000 from 25. That means there's $15,000. So that $15,000 comes out of the taxable account. Okay, you with me? Okay, cool. So let's look at this as an example. So option A was, here's the beginning. Okay, the IRA account is $500. The taxable account's $200. Now remember, the IRA account, we're taking the $25,000 out of the IRA account every year for 25 years. And so therefore, our account balance is $53,000. We depleted it, right? Pretty much, right? So it's at $53,000 over that 25-year period. Now the taxable account we left alone. So look at that. That grew, right? So it went from $200,000 to $520,000. So when you add these two up, your end total value after 25 years is $573,000. Congratulations. You still have a significant amount. You started with $700 and you still have $574,000. So not bad, right? Okay, so now let's look at option B. Okay, again, same scenario. Here's the IRA money. Here's the taxable money. Okay, so now what this one said is that we're taking required minimum distributions out of the IRA and then making up the difference out of the taxable. So in the IRA money, we have $181,000, so a little bit more than the other option, option A, right? And then the taxable account is a little bit lower than option A's, but it's at $433,000. When you add these two up from the last 25 years of income, now there's $615,000. So which option was greater? Option B has a higher account value, or does option A have a higher account value? Okay, so now you see how the distribution and how you withdraw money and the rules of the assets are important to where your future value of your accounts lie. Most people would have done option A because their IRA is their retirement account. It says it, individual retirement account. So therefore, I should be taking money out of that and leaving my savings, my taxable account, alone. Well, you saw how if we were to flip it upside down, what kind of value. Now, we didn't take into consideration any inflation or taxes going up or all those other things that could occur, right? We didn't care about that. We just wanted to show that how the distribution choices, withdrawal choices, have an effect on your overall account value and balance later on. Okay? All right. So now the other thing we talk about in our planning process is expense versus income planning. Now you heard me talk about this in the cash flow quadrant in the very beginning. You remember that in the very beginning an hour ago? So the expense versus income, what we were talking about is that people who have a job or self-employed, they have a job, their income is negotiated based on their experience and so on and so forth. Remember my analogy of the horse is the income and the expenses are the cart, right? And typically the expenses follow the income. Now if you add a couple horses, the cart can be bigger and your expenses can be bigger. Okay. Now what we do in our planning process is we actually flip it upside down and we do the expense-based planning. We look at your expenses first and then we say your expenses dictate your income. What kind of income? How are we going to distribute this income? How are we going to accumulate this income? What assets do we have? So that's the importance of this process. So if we were to take a look at income, okay, so let's say you're 56 and you have $120,000 a year of income, okay, so $10,000 a month. Now here's that inflation number, 2.65. Remember I talked about that earlier? So here's that inflation number. So what this is saying is that at the end of the year, our income needs to increase to $123,000 to keep up with inflation. If we don't, and our income from one year to the next is still 120, then our purchasing power dropped from 120,000 down to 116. Okay, so we should have 123, but now we actually have 116,000 purchasing power. That's almost a $5,000 difference, right? So if we go down to now we hit age 65, 10 years later, and we retire. Now our original income was 120. We should be retiring at an income of 155,000. We should not be at 91,000 because then that means we lost what? That's right, about 30,000 of purchasing power. That's significant. Okay, we're just talking inflation. We're not talking about taxes or fees or anything else. Our expenses, we're just talking about income, right? So this is pretty significant. This is why we look at expense-based planning, because now if our expenses are at $6,000 a month or $72,000 a year and we're making $10,000 or 120, there's a difference, right? So take a look at here. So now inflation 2.6 based on our expenses. Let's say our expenses keep up with inflation. So let's go to 10 years. Now our expenses are at 93,000. Okay. If our income did not go up, look at what happened to our income. It was eaten away to 91. So our expenses now have become more than our income. So we have to have our income to be higher. Well, how do we do that? Well, if we have other assets, that can help. Well, what kind of risk are we going to take in those other assets to get this extra money? I don't know. That's part of the planning process. We got to figure out what assets we are, what we have, the rules, and how they're affected. So if your income kept up at 155 and your expenses, so you're living the same lifestyle today as you did 10 years ago. If there's any fluctuation in any of these, you see where the planning process or the planning problem occurs. As we move out to 20 years, look what happens. So our income, look at our expenses. So our expenses are driving the income cart, right? So if our expenses are 121,000, we need to be making. We need to have more assets. We need to have the ability to pull out more money for income, right? Why? Because your income's taxable. So this is where we start having that conversation of what's taxable income versus tax efficient income, right? So if I have all my income at retirement is taxable, then I have to take into consideration future tax brackets or future tax increases, as well as inflation, as well as my asset risks and rules. Okay, so we need to look at taxable income versus tax efficient income. Does that make sense? Okay, so when we look at all this from a tax perspective, here's where we're at, right? So our income from 120 falls in the 22% tax bracket. Okay, even if our income stayed up at 155, we're still in the 22% tax bracket. Okay, now if taxes go up 5%, now this is instead of 22, this is 27%. How does that affect our purchasing power or our income? It affects it, right? Okay. So let's look at this as an example and we go through this tax bracket planning with our clients. Okay, so let's take a look at our adjusted gross income is 155,000. So our total tax is 26,000. Well, how's that possible? Well, if we look at the first 77,000, we pay 8907, right? And so the difference between the 55,000 and the 77,000 is 78. So we multiply 78 times 22% equals 17,000. Add these two up, there's our tax cost. Okay? So when we look at net of taxes, we subtract the taxes from our net income. Now we're at 129,000. Our expenses are at 93. We have a leftover of 36,000. Okay, so that's good. We have discretionary income. Well, what are we doing with that discretionary income? Are we spending it or are we contributing it? Ooh, remember the 3 stages, contribution. So even in retirement, you can still contribute and plan for the future. So now, if we take the next step, what happens if taxes go up 10%? Okay, so what we did here is we took the same tax brackets and we increased them by 10%. Okay, so now because the laws and regulations changed, economic termite laws and regulations changed, and our taxes, another economic termite, increased by 10%, what's that do to my purchasing power? So now my income's at 155 like it was. Now my taxes are at 41,000 because of the increase. Remember, this is only federal taxes, not state taxes. And so now I have a net of 114. Now I have a leftover of 20,000. So the taxes ate away at $16,000 of my purchasing power or contributing power. So again, if all of our income is taxable versus tax efficient, what do? What assets do we have? Okay, so now you kind of see how when we do the planning process, why this is so important. Okay, so this is a great opportunity now that we're going to wrap this up. You've invested some significant time into this webinar, and we appreciate your time and effort. You've paid for it, so again, hopefully this information was very valuable. We wanted to make sure we included a lot of information. The workbook, again, hopefully was a great tool for you. If you did not go through it and finish it, please go through it and finish it. And if you look at page 20, you remember in the beginning of our webinar on page 8, one of the things I asked you to do was to list out your planners, your advisors, right? And then grade them. Okay, now that we've done all this, we've gone through this workshop and you've jotted down notes, you've looked at your situation, hopefully you've gotten some good information. Now on page 20, you can go back look at your current advisors again, and now you can grade them again. Based on the information we just shared with you, are your advisors preparing you, planning your future the way we talked about here, or in a similar way? It doesn't have to be exactly what we're doing, but is the information we shared, the rules that we've shared, are they doing the same for you? If not, then this is a great opportunity for you to click on the link, schedule that complimentary session. In that complimentary session, we're going to require you to take this workbook you just filled out and send it to us. Okay, we'll give you the instructions on what to do when you go to schedule the complimentary session. We'll reach out to you and we'll give you instructions. And also, if you're prepared, we'll also include in the planning process a income for life report. Okay, so what we'll do is we'll look at your income that you currently have now. So if you're still employed, we'll look at your income now. We'll look at your assets that you have for retirement, set up for retirement, and what your income needs will be for your future. Okay, and so that income for life report will be very, very helpful in understanding that. Okay, so again, I appreciate your time. This is Robert Wolf with Terra Firma Business and Financial Consultants. Take this opportunity, invest in a little bit extra time in this complimentary session, and I look forward to the next steps. If you choose not to take the next step of scheduling a complimentary session, perfectly fine. Timing is what it is. We're always available and we're always open to working with you at any point in time in the future if time and things change. So again, thank you so much for investing your time in yourself and in this workshop, and you have a great, great, great day.